Hey traders, welcome to Chad Bull. Ever wondered how institutional traders spot game-changing setups? Today you'll learn to trade like them using smart money concepts for top-down analysis. Whether you're a beginner or an experienced trader, this video will help you understand how to analyze the markets like a pro. So grab your notebook and let's get started. But what will you learn in this video? No need to worry, I'm about to give you more value than a $1,000 course. Here's what we will cover step by step. First, what is top-down analysis? Second, how to draw and identify advanced market structure. Third, how to draw and identify most effective order blocks. Fourth, how to identify fair value gaps. Fifth, how to identify liquidity pools. And we'll do all of this using multi-time frame analysis to sharpen your trading edge. Let's dive in. First things first, what is top-down analysis? It's a method where you analyze the market from the higher time frames down to the lower time frames. This helps you understand the bigger picture and align your trades with the overall trend. Think of it like zooming out on Google Map before zooming in to find your destination. For example, we start with the daily chart, then move to 4-hour, and finally the 15-minute chart. This way, you're not just trading blindly on lower time frames, but making informed decisions based on the broader market context. But why we need to look at multiple time frames instead of one?
Why?
Ever placed a trade that looked perfect on the 5-minute chart, only to watch it explode in your face? Yeah, we've all been there. But here's the truth. Trading on one time frame is like trying to win a chess game by only looking at one square. Alright, now let me hit you with the ultimate hack. How to layer smart money concepts across multiple time frames to see the market like a big player. No more confusion, no more guesswork. I'm talking laser-focused entries where institutions, retail, and price action all align. Stick with me. This is the secret which 99% of traders miss. So we break the market down into 3 key categories, each playing a crucial role in shaping a winning trade. First, the higher time frames, the weekly and daily charts. This is where we spot the major structure levels, the key zones where institutions are positioning themselves. These levels are the foundation of everything that happens in the market. If you're not paying attention to them, you're trading blind. Next, we move to the mid-level time frames, the 4-hour and 1-hour charts. This is where the real analysis happens. These time frames tell us the market's direction, reveal supply and demand zones, highlight order blocks, and expose liquidity pools where price is likely to react. This is where we build our trade setups, making sure they align with the bigger picture. Finally, we drop down to the lower time frames, the 15-minute and 5-minute charts. This is where precision comes in. We don't use these time frames to determine bias. We use them to fine-tune our entries, to get the best possible risk to reward, and to confirm that the setup we've built is ready to execute. Now, let's put this into action. According to the rule, let's start with higher time frame to get a clear picture of the overall trend before moving down to lower time frames. On the daily time frame, the main focus should be identifying whether the market is in an uptrend or downtrend by analyzing market structure, key levels, and trend direction. There's no need to get caught up in smaller price movements or useless chaos, just focus on the bigger picture. Let me show you how to analyze market structure like a pro. First, identify whether the market is creating higher highs and higher lows or lower highs and lower lows. On our daily chart of Euro USD, the market has been consistently forming higher highs and higher lows, confirming an uptrend. Now, let's analyze the next potential pattern. The price has broken above the previous higher high, conforming a break of structure, also known as BOS, which strengthened bullish momentum. Now this becomes our most recent higher high. Following a BOS, the previous higher low is adjusted to the low that led to the break of the earlier higher high, making this our new higher low. Understanding the current market behavior. Currently, Euro USD has broken the most recent higher high and now it's trading under it. This indicates that the market is still bullish unless a significant lower break of structure is formed. I know, you might be wondering how to apply the same method in downtrends. Don't worry, I'll keep it short. If the price forms lower highs and lower lows while breaking the previous bullish higher low, it signals a bearish trend. This sudden shift in trend is known as a change of character, also known as CHOC. If the bearish momentum continues, a break of the recent lower low further confirms the downtrend. Another key factor to check is whether the current market price is trading within a supply zone or a demand zone. Even if the market structure indicates a bullish trend, and at the same time, price is ranging inside a supply zone, then don't blindly enter a bullish trade. Wait for the supply zone to be broken. The same principle applies in a bearish trend. Remember, even the smallest movement on the daily time frame can completely shift the trend in lower time frames. Now let's zoom into the 4-hour time frame. The first step remains the same as on the daily time frame. Identify the market structure. However, in the 4-hour time frame, your analysis needs to be much more precise, because this is where institutional traders and banks operate. To stay ahead, we must follow their footprints, which requires an advanced study of market structure. So here I've already mapped it out on my chart, but this advanced SMC method of market structure takes over a month to learn, and even longer to truly master it. That's why I've developed an advanced SMC indicator for you. This indicator includes all the essential SMC and ICT trading features, such as advanced market structure analysis, automatic order block detection, buy and sell side liquidity zone detection, equilibrium levels, and market sessions, along with many other powerful tools. If you're interested, you can contact me on Telegram, link in the description. Now, let's dive into the strategy. After identifying the market structure, the next step is to draw order blocks. In simple terms, an order block is a key price zone where institutional traders, such as banks, hedge funds, and large financial institutions, have placed significant buy or sell orders. These zones act as strong support or resistance levels, where price often reacts before continuing its trend. But the real question is, how do you identify and draw order blocks? Let's break it down. If the market structure is bullish, like in this case, you need to find the last bearish candle before a strong upward move, especially if it has broken the recent structure. In our scenario, this candle is the perfect order block because this is the last bearish candle before an upward move, indicating that institutional traders have placed significant orders. However, the impulsive candle should not have very large wicks, as candles with such wicks are generally ineffective. Here, all the criteria for a valid order block are met. We have a strong impulsive move with low wick candle. Therefore, this last bearish candle before the impulsive move is our order block. An important point to remember is that your order blocks must contain a fair value gap, also known as FVG. This can make all the difference in your strategy. When a fair value gap and an order block come together, they create powerful trade setups, confirming institutional activity and sharpening trade precision for a more confident strategy. But what is a fair value gap? An FVG is a market imbalance or inefficiency that occurs when price moves rapidly in one direction, leaving a gap between candlesticks that wasn't efficiently traded. These gaps indicate areas where institutional traders may have left unfilled orders, making them key zones where price often retraces to fill the imbalance before continuing its trend. Combining fair value gaps with order blocks helps distinguish between weak and strong order blocks. When an FVG overlaps with an order block, it significantly increases the likelihood that price will revisit this zone before continuing its trend, making it a stronger and more reliable setup. By prioritizing order blocks with nearby FVGs, traders can filter out weaker setups and improve their overall trade accuracy. Here is how to identify fair value gap. First, you need to identify and draw order block. It may be bullish or bearish according to your market structure. Fair value gap form within a sequence of 3 consecutive candles. The gap exists between the high of the first candle and the low of the third candle, skipping the middle candle. And the gap in between is called fair value gap, also known as imbalance. You've now mastered how to spot the perfect market structure, order blocks, and fair value gaps to pinpoint superior reversal points. But don't be fooled, this alone won't guarantee you success in the market. Without a deep understanding of liquidity concepts, you're still missing the most crucial piece of professional trading. The good news? You don't have to do it all alone. My advanced SMC indicator will handle it for you, drawing everything with precision and saving you countless hours of analysis. Just contact me on Telegram, link in description. So what exactly is a liquidity pool? It's a crucial zone on the chart where a massive cluster of pending buy and sell orders accumulates. These pools form because retail traders commonly place their stop losses, pending orders, and take profits around these key levels. But here's where it gets interesting. Institutional traders, also known as smart money, actively seek out these zones to fill their large orders before driving the market in their desired direction. Understanding this gives you a powerful edge in trading. There are two types of liquidity pools you need to know: buy-side liquidity and sell-side liquidity. Buy-side liquidity builds up above resistance levels, swing highs, equal highs, and during bullish breakouts. Sell-side liquidity gathers below support levels, swing lows, equal lows, and in bearish breakouts, making it a prime target for smart money to sweep before shifting direction. Recognizing these zones can give you a serious edge in understanding market movements. But you might be thinking, how to identify and use liquidity pools for higher probability setups. For example, here in the chart of BTC/USD, the market is bullish. We've got a perfect order block, a valid fair value gap. Everything lines up flawlessly.
Nice.
So we take the trade, expecting a strong move. But then, boom! The price crashes right through our order block. What just happened? Here's the painful truth. Our order block was sitting right at a major support zone, or what many retail traders would call a double bottom. And that's exactly where the trap was set. Retail traders see this area as the ultimate buy zone, strong support plus an order block. It looks like a high probability setup. So they come in with buy orders, putting their stop losses just below. But this is where smart money steps in. Institutions don't play by retail rules. They need liquidity to execute their massive orders. And where do they find it? Right below those retail stop losses. When a stop loss gets hit, every retail trader who bought at that level instantly becomes seller. And here's the secret. Institutions need a massive number of sellers to execute their huge buy orders. That's why they will always try to hunt your stop loss before triggering the actual reversal. That's exactly what happened here. The institutions drove the price down, breaking through your order block, making it look like a failed setup. But in reality, they were collecting all the liquidity sitting at that support level. Your stop loss was their entry. And if you look even closer, just below this sell-side liquidity, there was another untouched order block with a valid fair value gap. This wasn't a coincidence. It was part of the plan. Institutions didn't just stop at taking liquidity. They used this unfilled order block as fuel for their trade. Once they had absorbed enough sell orders, they executed their massive buys right from this level. Now see, this was the real trade. This is a common pattern. After sweeping liquidity, the market often reacts to order blocks before making its true move. Recognizing this behavior gives you the ability to anticipate institutional setups instead of falling victim to them. Now that we have a clear and confident view of market structure and have locked in the best possible order block, it's time to take our analysis to the next level. Let's shift to a lower time frame for even greater precision. By zooming into the 15-minute chart of Euro/USD, we will refine our trade, pinpoint the best possible entries, and fine-tune our risk management, all while maximizing risk to reward potential. This is where smart trading truly comes to life. Now, let's shift our focus to the chart. As soon as we drop down to the 15-minute time frame, the first thing we need to do is identify the market structure, making sure it aligns with the 4-hour and daily trends. And here's exactly what we wanted to see: a strong bullish market structure, confirming that the higher time frames are in sync with our setup. But what if the lower time frame isn't bullish? Then don't trade against the trend. Never force a counter-trend trade. Instead, wait for a clear change of character before making a move. For the highest accuracy setups, the lower timeframe direction must align with the higher timeframe trend. This is the key to trading with confidence and precision. Now that we've confirmed the market structure on the lower timeframe aligns perfectly with the higher timeframes, it's time for the next crucial step: identifying liquidity pools. Let me show you exactly how to do it. This right here is our liquidity pool. Why? Because it's a double bottom, making it a prime target for liquidity grabs. And just above this liquidity pool, we have our order block, the key zone we're watching. But here's the crucial part: we're not jumping in blindly. We won't execute our order the moment price reaches this order block. Why? Because smart money loves to manipulate these areas, often breaking the order block and sweeping the previous low to grab liquidity before making the real move. That's why we wait and watch, like a hunter stalking its prey, and when the right opportunity comes, we strike. And what if the market doesn't hunt liquidity and reverses immediately from here? No worries, we have a plan for that too. Trading isn't about reacting emotionally, it's about staying prepared for every scenario. Focus on the chart, let's see what happens now. The price drops down, breaks through our order block, and sweeps all the liquidity. just as we anticipated. Retail traders who bought here, their stop losses got hit, flipping them into sellers. And that's exactly what institutions needed, a flood of sell orders to execute their massive buys with minimal slippage. And the traders who sold after the order block and double bottom break, once their stop losses get hit, they're turned into buyers, fueling even more bullish momentum. At this point, we know liquidity has been taken, meaning the stage is set for a potential reversal. But we're not rushing in. We're staying patient and waiting for the perfect entry. To fine-tune our trade, we drop down to the 5-minute time frame, and what do we see? A fresh order block forming. Now we wait for a change of character in 5-minute time frame. It's the first sign of a shift in momentum. Now, once the price comes back for a retest order block area, that's our moment to strike. This is how smart traders play the game. Trade executed. Now let's see the outcome. We've entered the market, and our exit target is set at the swing high on the 15-minute time frame. Now let's watch it play out. And there it is. Our trade was a success. The market moved exactly as expected, proving once again that smart money concepts give us a real edge. But what if the market doesn't grab liquidity? Not every setup follows the same script. Sometimes, the market won't dip lower to sweep liquidity before reversing. So what's the plan in that case? Let me show you in short. Wait for the price to reach the order block. No chasing, just patience. Drop to the 5-minute chart. This helps us refine our entry with precision. Look for a change of character. This is our confirmation that momentum is shifting. Identify the new order block. Once the change of character is in place, find the fresh order block forming. Enter on the retest. When the price pulls back to the new order block, that's our moment to strike. By following this method, we stay disciplined, precise, and always one step ahead of the market. This is the mindset of a smart trader. Thanks for watching the full video, and here's the surprise for watching it full. Just DM me SMC PDF in Telegram, and you will get an SMC PDF for free.